Hello everyone, it's none other than your boy Chatmaster. I welcome you all to Chatmaster FX. Today we are going to look at an interesting subject which is called compression. This is one of the pillars of understanding the market structure. So this is kind of a broad subject and I cannot be able to cover it in one video. I need about 20 videos to cover compression in its totality. So I'm going to simplify things as usual so that you may have a basic understanding of compression. So compression is one of the price approaching strategies, which means it's one of the strikers. It acts as a confirmation SOP. Once you have determined your defense, your midfielders, then you look for a striker to help you to score goals. So compression can be able to do that. So let's dive straight to the business of today. So this is the anatomy of compression, guys. As usual, the first thing that you need to identify is a certain decision point. Once you identify a certain decision point, then you wait for the price to approach that decision point, then you can be able to place your trade. So as you can see, guys, we have an MPL of type 1, and the price approached that MPL in the form of compression. So compression, in other words, is actually a weak momentum where we are saying the price is moving with slow liquidity. It's not moving in a high speed. So there are various ways of considering or validating whether the setup is a compression or not. Some uses the degrees, like usually. If you can draw your line here, connecting the compression, and you look at the angle here, this angle should be less than 45 degrees. This is how other people define compression. So compression, the theory of compression, basically, we are saying the orders, the buy orders are being consumed here as the price is approaching a valid supply. So what happens is that, especially if you check those who do trading, what happens is that once you place your trade here and the price goes up, once the price goes up, it makes a retracement, then there will be some orders waiting here. So the market comes back to collect those buying orders, so there are no longer orders left here. The price goes up and some people put the pending orders here, the buy pending orders here, then those orders are consumed again, the market goes up, and there will be other pending orders again because people enter into trades on retracement. It says you are using a Fibonacci retracement tool and you wait for the price to come. Maybe this will be 61.8%. You wait for the price to come here, so your pending order is activated and the price starts to go up. So you realize that these orders, they are no longer orders left behind here. All these orders as well are consumed. These orders 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 are consumed. And finally, the price reaches a strong supply zone. Then the price drops. Why does the price drop here? it drops to cover the accumulation or the compression. And why does it happen? It is because there are no longer orders left here. All these orders will have been consumed. So let's say, for instance, there are some orders left here. If there are orders left here, what happens is that when the price comes to an area where there are orders that have not been triggered, then the price is more likely to react to some extent, maybe going back to this zone or somewhere here, then it drops. So when the institutional traders are looking at compression, what they don't want is anything that can hinder the movement of price here. They don't want to see such a scenario. They just want a free flow of price to cover the compression. So what happens is that as the market is moving up, it consumes all the orders. There will be just a few orders left behind as the price is moving, so that they can enjoy some profits in a short period of time, because this spike will just happen maybe in 30 minutes, but this compression maybe we have taken, let's say, 12 hours, you see. So that's the conception behind compression, guys. Compression is a broader subject. It's a broader subject. I don't know how many videos I need to explain compression. So as for me, the way I view the market is a combination of compression and liquidity, where the price is compressing to some extent, and sometimes it's doing a liquidity pull, compression and liquidity pull, compression and liquidity pull. That's how I view the market. So there are various ways for us to define compression. One of the things that we can be able to use, these are order blocks. You can be able to use order blocks. So you draw your order block here, 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 until you finish all the order blocks. So what happens is that in order for us to define compression in terms of order blocks, we will be just saying compression, these are clustered order blocks, whereby we are saying if I draw some order blocks here, they should be clustered in a certain way that there will be no space between the order blocks. They will be clustered and not having some free flows here. So once you have something like that, then it can qualify to be a compression. So there are various ways for you to use. You can use the order blocks and see if there are spaces, then the price is more likely to react from that space and maybe make a retracement, because there will be a space left. So there should be no space left. All the orders should be consumed on the way up. So as I have said, one of the things that you can be able to use to define compression is that this angle should be less than 45 degrees as the market is moving up. Another thing is that you can be able to draw your order blocks here, and if there is no definite order in the order blocks, then that's what compression is. That's what compression is. So you draw your order blocks. There should not be some spaces on your order blocks. Then if you see that there are no spaces, then you can validate that as compression. The other thing, guys, as for me, I don't use order blocks. I use what I call supply zones and demand zones. So in this case, this is a demand, this is a demand. You draw your demand zone. When you are drawing your demand zone, you look at the last candlestick before the price moved with great momentum to the upside. Then you look at that candlestick. So this one needs an idea of some candlestick patterns, because you'll be looking at doji candlesticks, you'll be looking at engulfing candlesticks, you'll be looking at the inside bar candlesticks. So you need to understand all those types of candlesticks in order for you to draw your supply zones very well. So once you see, also the concept becomes the same as compared to order blocks. Once you see that your supply zones are clustered, then that's what is compression. There should be a clustering of the zones that you have drawn, which means all the orders have been consumed. So once we find a certain scenario like that, then we know that more likely when the price reaches a strong supply here, then the price is more likely to drop. So take note that this might be an MPL, a QM level, or it might be an ignored level, or it might be a strong supply. So basically, when it comes to trading these standard operating procedures, because you can see that these concepts that we use here, they are more related to supply and demand. So you need a good ideology of how to draw your supply zones so that you can be able to qualify. And there is a certain way that is used to qualify whether a zone is strong or weak. That helps you so that when you see that the price is coming towards your supply zone, if the price is doing a compression towards a strong supply zone, then the price is more likely to turn from there. But if the supply zone is weak, that's where you see that the compression may continue up and that zone fails to hold the price. So you need to make sure that you understand supply zones that are more stronger and supply zones that are weak. So usually when you have a supply like the MPL, that's why we mostly use the MPL here to validate the significance or the how strong the zone is. So you can use different decision points there, the MPL, the W Maru, etc. So guys, this is what compression is. If I start to explain compression, I may not finish this video, but with what I have said so far, I think you have just obtained an idea of what compression is. So what you do is that you put your stop loss above the MPL, then your target profit will be the origin of compression. So we have different types of compression. We have what we call an equilibrium compression, where the compression is actually happening both sides. In such a circumvent, the price is more likely to go either sides. And we have what we call break into compression. When we are looking at the break into compression, guys, you will see when I present a video on the flip trend line, it's actually one of the ways for you to determine that there is a break into compression. So maybe you are not very sure that your supply zone is more likely to hold the price. You wait for that condition to happen. So what is break into compression? Break into compression is whereby you see this market is creating some higher highs here, and you can see this low. Once this low is broken, when this low is broken, then that's what we call break into compression. Once this is engulfed, then that's what we call break into compression. So this is what happens most of the times in compression. When the price breaks here, it doesn't give you time to come back again in order for you to place a trade. Once it breaks here, it just moves in a strong move going to cover the compression zone. But if you are lucky, you can wait for that confirmation where the price breaks into compression, then the price accumulates again going to this supply zone, then you can be able to sell after confirming that there is a break into compression. But usually the price just drops and you will miss many of the trades. But if you just want to be sure and you want to be risk conservative, you may wait for that condition. So let's go to the terms and conditions. There should be an MPL or any valid decision point. I have said that before. The price should approach the MPL by accumulation. So accumulation is more or less compression. Entry, enter at a valid decision point. Stop loss, the stop loss should be above the MPL. Target profit, the target profit should be at the beginning of compression. So these are the terms and conditions of compression. So let's go straight to some chart examples. So here guys, we are on volatility 25 1S index on M15. We have an MPL here. Once we have an MPL here, you can see that the price dropped with strong momentum. This strong momentum helps us to know that if the price compresses here, there's shift in momentum, there's strong momentum and weak momentum. So it's more likely of a scenario of momentum shift. And you can see that there was a break of this support as the price went down. It's another also thing that helps you to see the significance of your setup. So once all those conditions have been met, then the price started to compress going to the MPL. Usually, most of the times, you may find some compression that are associated with the 3 drive. So this compression is moving in a channel. It's a compression in a channel. These types of compression, they are very effective. They are very, very effective, guys. So this is a compression in conjunction with the 3 drive. So you can see that this setup is suiting the 3 drive and is suiting also the compression. So the price came to the MPL area and it dropped. So you can see, guys, some confluences in these things. Guys, this is a kind of a quasi-model level here. And this one is kind of an MPL or a valid decision point. So we can also consider this as a quasi-model. You see the confluence of the standard operating procedures that we have. So guys, you need to understand all the standard operating procedures that we have. You may not use all these standard operating procedures that we have, but just having a general understanding of what is a quasi-model, what is a diamond, what is an SDE, all those things helps you so that when you see them in the market, they can help you to make a confluence. So the idea behind is that the compression will be covered, and you can see that the price came to cover compression and it went where it was going, but first it needs to cover compression. So this is what I was talking about. Was there break into compression here? No, there was no break into compression. So look, most when the price just drops, it might not give you a chance for a re-entry, because it might just drop with the power, with the strong momentum going to the target profit. So yeah, guys, as you can see, if I can draw my order blocks here, you can see that there was no much space between these order blocks or some demand zones here. So they were consumed. Many of the orders were consumed all the way to the upside. They were consumed. So that's why you see a drop in price that occurred here. You can see that this, as the price went up here, this demand was not consumed. There were some orders that were still there. That's why you see that the market reacted for a short while here, and it was held by this left shoulder, and the price definitely dropped. So this is example number 1, guys. Let's go to example number 2. On example number 2 here, we are in boom 500 index on M30. So guys, we have our MPL here. Once you identify your MPL, what happened is that you can see, guys, there was a weak momentum to the valid MPL, and as you can see, guys, this is more of a momentum shift, guys. The price came and went up with strong momentum and it came with weak momentum. So yeah, you need to know those things, guys. And there was a break of resistance here. So those are further confluences. And what happened is the price approached the MPO. It approached it in the form of a 3 drive. And also there was a compression. Compression simply, guys, you can see this demand. If you can draw some order blocks here, you can see that all these orders were cleared as the price was coming to the significant decision point. So once the orders are consumed, guys, the price is free to come back to the origin of the compression, guys. So there was a huge movement of price here to the upside. So when it reaches the target, then the price is free to do whatever it wants to do. It may continue to the upside or it might drop down. So this is a good example, guys, of a compression. So this is a compression in the form of a channel, and with the 3 drive confluence, and also there was a momentum shift, guys. So you can see, guys, this MPL, there was an immediate demand zone here. So you only see an immediate demand zone. It's actually safe for you just to put your stop loss below that immediate demand zone, because the price may be attracted to that demand zone. Yeah, guys, that's it on example number 2. Let's go to example number 3. On example number 3, guys, it's the same setup. It's the same setup here. Let's go to example number 4. On example number 4, guys, here we have an MPL. We have an MPL here. Once we have an MPL, what happened is that the price dropped with strong momentum to the downside. And once the price dropped with strong momentum to the downside, you can see that the price went up to that MPL in the form of compression, guys. This demand was taken out, this one was taken out, so there was a clustered types of order blocks here. There was no space in these order blocks, which means all these demands have been taken out. So as the price comes back here to cover this compression, the price will never face any resistance here on its way to the downside. So guys, our standard operating procedures confluence each other. This one, guys, is kind of a claw where we can draw our key level here, and if we draw our key level here, we then draw our golden zone. Once we draw our golden zone, then we wait for the price to come to that golden zone, then we can be able to place a trade there. So guys, there was a compression there towards the MPL area, and you can see the type of compression, a compression in the form of a channel. These compressions, guys, they are very good, guys, and you can see that the price was able to react on that valid decision point. So we are on example number 5 on step index H1. This one, guys, we have an MPL area here. This was not a shift in momentum. As you can see, there was no strong momentum to the downside. So an MPL located in a movement of price where there was no strong movement to the downside, it might have its disadvantages, because maybe if the price comes here, it might not respect the MPL. But usually, if we just know that there's a good decision point here, you can be able to place a trade. But placing a trade where there's a strong momentum to the downside, it actually gives you confluence. So you can see, guys, that as the price was coming up to the MPL area, the price came, you can see they were kind of clustered order blocks here, although maybe there were some spaces, in the order blocks, but you can see in the movement of price that the price was able to approach this MPL. in a compression manner. And this was kind of a 3 drive, guys. As you can see, there was kind of a 3 drive here. So yeah, guys, this is compression, guys. And so what happens, the price will cover the whole compression zone, and the price compressed to our target profit, and from there the price started to do whatever it wanted, but we have secured our profits here. So guys, generally this is what we call compression. It's a broader subject. It's a broader subject, guys. So for the sake of this course, I was able to compress I was able to compress the compression things so that I don't confuse you guys. This concept is very, very powerful. It's one of my favorite, and it needs some skills. It needs some technical skills. You need to know how to draw your demand zones or your supply zones or your order blocks in order for you to determine whether the compression is valid or not. So thank you guys for watching this video. Don't forget to like, subscribe, and share. It's your boy Chatmaster here, signing out.